This is your brain on risk. This is Mind Over Money, the podcast where Kevin Cook exposes the psychology of investing.
Welcome back to Mind Over Money. I'm Kevin Cook, your field guide and storyteller for the fascinating arena of behavioral economics. I have a special interest in helping kids with math. That's because I struggled in high school with algebra and trigonometry and you name it, and certainly never made it to calculus. And my prospects for learning higher math didn't begin to change until I entered the world of financial markets at the age of 29. I read books by and about great traders, and one message they all had for me was that I needed to learn the basic mechanics of probability. While equations still intimidated me, it was the stories and games of chance, like poker, that pulled me into math. I went from still being allergic to algebra at 20 years old to diving in at 30 and creating a career for myself as an institutional currency trader, handling over $100 million per day. More on my story-based approach to learning math coming up. So I spent most of my 30s teaching myself probability and stats, which are inseparable from some aspects of finance, like options pricing and trading. After I learned about behavioral finance and some aspects of neuroscience and applied those fields to my studies of why traders fail, I realized that probability is also inseparable from being a generally intelligent person outside of finance. I've written much about this over the years, but I was initially inspired to make this a podcast about it after seeing a casual post on Twitter in late August. This is from a woman named Maya Sen, who is a professor of public policy at the Harvard Kennedy School. Here was her tweet. Early morning hot take. We would be a lot better off if we taught teenagers basic statistics and causal inference instead of trigonometry. And she posted that at 5 a.m. on August 26, 2019. All right, so Maya Sen is also the author of a book called Deep Roots, How Slavery Still Shapes Southern Politics. All right, then this Labor Day was yesterday. Today is Tuesday, September 3rd. I was inspired yet again to get moving on this podcast because I saw a 4-minute video on Twitter about labor unions by economist Robert Reich. It's a good short lecture from the professor that I recommend to every thinking person who cares about the intersections of politics and economics. I will link to it in the article version of this podcast that will appear on the Zacks website. As I always do, I create sort of an article. It's not a complete transcript of the podcast, but it'll always have the additional links and other explanations that I may have forgotten to sort out in the live podcast here. All right, in the comments section of my retweet of Robert Reich's posted video, I respond to his 5 big lies about unions with my own 5-point reaction. Right now, though, I want to highlight one use of stats that Reich employed in his presentation. He, while he's arguing about, I think the first big lie about labor unions was that unions are bad for workers. And of course, he goes into, many things about economics and tries to argue that, hey, unions are even good for workers who aren't in unions. It's good for all workers and the economy. But one chart he shows is pretty interesting. It shows a correlation. Okay, the title of it is, as union membership rates decrease, middle-class incomes shrink. And what he's got plotted here since about 1970 to, say, 2012, 13, is a decline in union membership, obviously, and corresponding to that line, roughly in some sort of very close correlation, is the middle class share of the economy. So, middle class share of aggregate income is the way he expresses it. Now, what this the way he's using this graphical stat is to show us that, hey, there must be a strong correlation between the decline in union membership and the size of the middle class and the middle class share of the economy, so to speak. So think of, and I don't know if this is versus GDP, but the right-hand side says middle class share of aggregate income. And I'm not so sure if there is causation here. This obviously there's correlation, but in my response to Robert Reich's 5 Big Lies About Unions, I see many other things impacting whether or the degree to which unions have declined and the economy has changed, in terms of manufacturing jobs moving overseas. That's about technology innovation and free trade, globalization. Now, you may not like the fact that America has lost manufacturing jobs to overseas competitors, but and you may think that there are policy reasons behind it, but the big drivers of technology and free trade and innovation in general are the driving forces there, and not necessarily a conspiratorial attack against unions. So that's a big debate. Obviously, you should go on my Twitter feed and look for the post, or search me or search Robert Reich and find the 5 Big Lies About Unions. Watch that 4-minute video. I'll link to it in the article version on Zax.com, and join that debate and respond to my 5 rebuttals. I actually agree with some of the things that Reich says about the economy and workers, but in this particular case, I'm wondering if we have a correlation here that is being presented as causal inference. Okay, let's keep going with today's dive into Probability 101, or How Not to Be a Sucker. When it comes to the fields of economics and politics, there is no shortage of people trying to persuade you with statistics, if not outright deceive you. And it's easy to be fooled by fancy, colorful charts with crisp, clean labels, like we may have just experienced with Robert Reich's chart. But successful deception with slick graphics and internet posts is at least as old as the 1954 book How to Lie with Statistics by the journalist Darrell Huff. In presenting an introduction to stats for the general reader, Huff did not need to be a statistician. He was simply an astute observer of the ways that facts and figures, especially in graphic form, could be used to influence people, even trick them intentionally. Now, what I didn't know about Darrell Huff and this book, this is something interesting. This comes from Wikipedia. In the 1960s, Huff was funded by the tobacco industry to produce a follow-up book titled How to Lie with Smoking Statistics that attempted to use statistical arguments to undermine claims that smoking was harmful to health. The book was never published by Huff and has subsequently been criticized by statisticians for his involvement and the arguments advanced in draft copies. So they got caught early on what they were up to. So here's the guy who wrote the textbook, which is obviously, it's been used in a lot of college stats courses. You may know it. Ask anybody who's been in stats, and they've probably seen the book. Apparently, it sold more copies than any book involving stats. But since he taught us how to lie with them, he got hired by Big Tobacco, to do the same and to refute any sort of medical or scientific research claims connecting smoking and lung disease, which he could certainly do. He could draw other correlations and steer you away. So when you think about it, this is obviously something we have to be on watch for. I think of the big battles going on right now in food and medicine. I mean, think about so big food, whether it's the dairy industry, the beef industry, they can not only lobby in Washington, they can do their own research and publish stats to convince you of one thing or another. So we have to be on watch for that. I mean, what have we just gone through in the past, say, 40 years, where in the 70s, maybe it started in the 60s, we learned that, cholesterol is bad for you, fat is bad for you. This is what's causing heart disease. And then, that's being turned upside down now, that actually, fat isn't as bad for you as everybody thought. And sugar is probably one of the predominant causes of heart inflammation that could lead to clogged arteries and other, or diabetes even. So, the medical industry and big food are closely intertwined here in giving us good research or research that suits somebody's agenda. What other industries? Energy. Wouldn't big oil have an incentive to promote research from scientists who, don't believe in climate change or don't draw any substantial conclusions about any greenhouse effects or greenhouse gases causing climate change? Of course. And right now, we just entered hurricane season with, as I speak, Dorian has been downgraded from a Category 5 storm, the strongest, maybe down to a Category 2, but still headed towards the southeast coast. Many people who believe strongly in ideas and research about humans creating climate change for the worse, for the negative, want to point to, look at all the hurricanes we're having, and look at their intensity. Isn't this, global warming? But what's funny is, I guess there was a story today that somebody tried to use whatever climate change science or evidence they could muster to say, no, it actually stopped Hurricane Dorian from getting worse, which is just, which is hilarious and beautiful. And this is the way that, people can use stats to lie. So my whole thing is, this is why, your 10-year-old, your 15-year-old, your 20-year-old needs to learn basic probability and statistics to sort of immunize themselves against all the information out there, all the influencers and posters on the internet and YouTubers and people on Twitter who come up with whatever story they want to tell with numbers and facts. What about the trade wars? We have a president saying that we lose $600 billion a year to China every year. Well, it's actually a little more complicated than that, since American consumers want cheap goods, we're willing to pay for them and have this trade deficit with China. What about who pays the tariffs? The White House is convinced that when we slap tariffs on Chinese goods, that the Chinese are paying us money into our treasury. Another interesting use of economic facts. What about gold? Gold's a place where research in finance could be used to persuade you to accumulate more gold now, especially as it's back above $1,500 an ounce here. I just did a podcast a couple hours ago with my colleague Tracy Reinick, who is the host of the Market Edge podcast, where I give the fundamental arguments against investing in gold. Now, I'm not saying you can't own any gold or allocate a small portion, but I'm trying to educate people about why this run in gold may be more of a short-term effect of hype and extremely low interest rates. We have Europe going to negative interest rates, the U.S. getting ready to cut interest rates again, and this has made gold more attractive. It's not about an economic collapse. It's not about the dollar going away or the euro going away. So definitely listen to that podcast. I give at least 3, maybe 4 very strong fundamental arguments from different places, from completely different directions about why gold is not a good long-term investment. And I'll just summarize them real quick for you. First of all, fiat central banking is here to stay. We dropped the gold standard in 1971, and the sophistication of finance with fiat central banking and the digital economy has only become more entrenched. It's here to stay. Nothing's making that go away. Number 2, technology innovation. Technology drives economic growth and wealth creation, period. And I give several asset classes that you want to be invested in besides gold, mainly stocks. And that leads to my third argument. If people think that you want to own gold to fight inflation, well, there are so many better ways to fight inflation by investing in equities, period. Just, you could buy the S&P index. It's always going to do better than gold in any 2, 3, 5, 10-year period. And then select industries, whether it's artificial intelligence and big data, genomics, things that are creating the future. All right, so make sure you listen to that podcast. And then my fourth reason is basically that, look what just happened. And I predicted the gold run from 1200 to 2000. I was on CNBC with Maria Bartiromo in 2009 when gold was trading about $1,150. And I explained to her why gold could go to 2000 because the banks were ramping up quantitative easing, QE, and money printing, buying bonds with money that didn't exist before. Moving fresh cash into financial markets, and how that if gold was going to, not replicate, but be the result of that impact, then gold would have to rally higher, and it did. But there was a lot of hype in that too, where everybody thought they had to own gold. When I say everybody, I'm not just talking about your neighbors and your parents and your Uncle Joe. I'm talking about every financial fund thought, oh my gosh, we need to have a bigger stake in gold. And they ran it up to 1900 and then it crashed. And what's happened since then? Stocks have done nothing but go higher. And some industries, are up 300, 400, 500% because of their growth of productivity with no inflation, as it just makes everybody more productive. You think about the mobile phone you hold in your hand, or fracking for the oil industry. More examples of technology innovation driving growth and wealth creation, and gold is not a hedge against inflation as much as equities clobber inflation year after year. Okay, so all these things are important to think about, and when I think about it in terms of kids, what kids need to grow up to immunize themselves against people lying to them with stats, learning basic probability and stats, is critical, because you need those skills to understand and interpret science. I mean, look at the whole climate change, global warming thing. That's some of the most complicated science because, geology and weather have patterns that can happen over decades. I was just reading this morning about how the Sahara, as recently as, say, 10,000 years ago, it was still a very lush garden type climate and ecosystem, with fresh running water and forests and, abundant wildlife. And it only became a desert, in the past 10,000 years. So, yeah, climate change is real, but figuring out the causation of what humans are doing with our energy systems, that's trickier. So this is why kids need to work in science, understand science, interpret data, read a journal article, and be able to understand. They need basic probability and stats education. We need it more than ever to help us inform decision-making from the kitchen table to the boardroom to Congress and the White House. Now, so my goal is to get people and kids, as if kids are lesser people, but they're not, more interested in learning about math. And remember, I said that I struggled with it, but when I found stories that pulled me in, then I had a reason to look at the equations. And this was this was long before I saw the film Moneyball with Brad Pitt. I mean, how cool was that he finds this relationship? Basically, this is like the first big data story, right? We weren't even saying the phrase big data 5 years ago, at least as investors. We really did. Maybe we started saying big data like in 2014 or something. But the whole Oakland A's story, how this guy came up with looking at the stats and finding the right correlations and causations or relationships that would lead to more hits, more on base, more runs consistently. That's a fascinating story about math and big data. Another story that helped me a little later was the Black Swan, the book by Nassim Nicholas Taleb. And that book was powerful because I was a currency trader, and I knew a fair amount about options and options dynamics. But I didn't fully understand, the complexities of standard deviation and volatility and how they were being used in financial markets. And what Taleb showed us with the book, The Black Swan, was that Wall Street and finance in aggregate, they were building financial models based on something as simple as standard deviation to tell us what the risk in an asset was. And what everybody was missing, that Taleb pointed out with the help of one of his mentors, Benoit Mandelbrot, was the wild randomness of financial markets. See, standard deviation works for measuring things like the height of humans or any physical attribute of a plant or an animal. There are going to be averages that matter and a standard deviation that you can calculate for all kinds of physical phenomena. But financial markets are not physical phenomena with any standard deviation. When wild things can happen. That's why Benoit Mandelbrot called it wild randomness. And my conclusion after reading Taleb was, when anything can happen, there is no standard for deviation. And you can quote me on that. So that was a powerful thing to learn from Taleb. Now, the reason that Taleb comes back into this conversation from another angle is that Nassim Nicholas Taleb does not believe in psychology. He thinks that psychology is a pseudoscience and that 99% of psychologists and theorists there involved should quit now and stop wasting our time. And this is a very hardline stance from him. And I'm going to investigate it further, probably write an article about it at some point. But I need to learn more from him because, first of all, Taleb, he calls himself a trader turned philosopher, or as I call myself, a philosopher turned trader. But anyway, he's a math geek. I mean, he knows his math inside and out. He's just written a new textbook on probability. So he's 1,000 times the mathematician that that any of us could ever aspire to be. But he takes this hard line against the pseudoscience of psychology, and it surprises me because he's actually acquaintances with Daniel Kahneman, the psychologist who basically created the field of behavioral finance. So that's something I need to do more research on, is where does Taleb, he likes Kahneman. He respects Kahneman. They've done talks and conferences together. So I need to find out where their differences lie and exactly what Taleb's beliefs are about, say, something like behavioral finance, where you can just do a simple test and give people a probability puzzle or a situation and find out generally what percentage of people will exhibit what we might call either rational or irrational tendencies, and that's what Kahneman's famous for. He got a Nobel Prize for it because his work was groundbreaking in proving that people can tend to be more irrational than they believe, especially when it comes to decisions about money, risk, uncertainty. All right, so now what we're going to do when I come back, actually, is we are going to go through 3 or 4 lessons in probability with my story-based approach to teaching math. And these are lessons that any 10-year-old or 20-year-old should learn as soon as possible. And if you are in that age range, then I hope this helps. And what would be even cooler is if we had some adults in the room who want to pass this knowledge on to their kids, their grandkids, their nieces and nephews, or anyone they know. All right, I'll be back faster than you can spell technological innovation. Now it's time for some story-based math lessons. This is the way that pulled me into math and helped me make a career in the financial markets, where I, couldn't stare at equations, but if I had a good story to pull me in, it made me want to learn the equations. And one of the first was the original story of how probability was invented, because there was, real money at risk and a real gambler trader who needed the answers, and somebody gave him the equations he needed. And this goes back to France in the 1650s. A gentleman gambler named the Chevalier de Mer, or that was his title, Chevalier de Mer. He played a couple of dice games with unwitting strangers, or possibly former friends. And one of the games was, roll a single die. What are the chances that you get a 6 in 4 rolls of a single die? He also played a lengthier version where he would bet somebody on the probability of getting double 6s in 24 rolls of 2 die. So he's got one game, single die. What are the chances you get a 6 in 4 rolls? And then with a pair of dice, what are the chances you get double 6s? At least one double 6 in 24 rolls of a die. So he played these games quite a bit with people, and he thought the probabilities were equal. The way he did the math, he did a simple calculation. He said, well, the probability of getting, a 6 in 1 roll is 1/6. So, which is true. The same logic applies. How many, what's the probability you get a double 6, with a pair of dice in any given roll, and it's 1 in 36. So, but he calculated that both of these probabilities were equal for the max number of rolls, 4 rolls and 24 rolls, but he was getting different results, and he did not understand why. And I'm not telling the story very good right now because I'm just recalling it from memory. But this is a story that you want to just Google it. And hopefully you find it on a good stats or math website. Here, I'll give you one right now. Let's see. Do a quick search here. Chevalier de Mer. Okay. All right. Yeah, here's a good one. This is somebody's got a WordPress site called Introductory Statistics. So it's Introductory Stats is their website. And they title it One Gambling Problem That Launched Modern Probability Theory, which is true. Because the Chevalier was losing money more on one bet than another. And I think it was that because of the way he calculated the probabilities, he thought they were equal. It was actually a better probability to get 1/6 in 4 rolls of a single die than to get a double 6 in 24 rolls. But the probability was very small, but he played enough that it showed up. Like I think it works out that I can't tell you how it works out because we don't know yet. How did he solve the problem? He solved the problem by going to his mathematician friend, Pascal, a mathematician you may have heard of. And Pascal was equally intrigued by why he would get such different results for these rolls of the dice. And so he consulted his math buddy, Fermat. And together they exchanged a series of letters, which have now become famous, because the two of them figured out how to calculate the correct probabilities for these two games. And it turned out that they did have different probabilities for the probability of rolling 1/6, at least 1/6, in 4 rolls of a single die. Turned out the probability was close to 52%, 51.77%, you could say. But the other gambling game of trying to get at least one double 6 in 24 rolls was less than half. It was like 48 point something. So we'll just call it 49%. So slightly different probabilities that obviously added up over time in the Chevalier's pocketbook. And so this was basically the solving the solution to modern probability or probability at all. And what these two guys figured out, Pascal and Fermat, was that you had to multiply by the probability of not getting something. So, for instance, the probability of getting no 6s in 4 rolls is 5/6 times 5/6 times 5/6 times 5/6, and that comes out to 0.4822. And then, like, when I read this, it just like blew my mind because I was like, whoa, they figured this out because, they came at it the other way. What was the probability of not getting something? So that made more sense. And then you just flipped it over. So then you subtract 0.482253 from the number 1 and you get 0.5177. So 51.77% chance of getting at least 1/4 in 4 rolls of a fair die. And so, the probability of something not happening is really, like, it just pulled me in. I was like, wow, this is fascinating, because I was already a philosophy major in college, and now I had something I could wrap my very verbal brain around, and that it all of a sudden made math absolutely fascinating. Also working on the trading floor at the Chicago Mercantile Exchange, that was also another force driving me to make math interesting, because I saw these people, making money, losing money based on their abilities with math. And then I also read the stories, as I mentioned in the first half of the podcast, about all the great traders who said, you really got to learn basic probability mechanics to succeed in this business. So all this was pulling me in. And this led to, something like, all of a sudden, then I was walking around talking about expected value, something that nobody ever heard from my mouth before I was 30, and how to calculate roulette probabilities, which is very similar. Like, so the way roulette works, that math equation. See, there's a simple one right there. So I give you this story that I didn't tell very well, but you're going to look up about the Chevalier des Mers. If you don't know the story, you're going to look it up and be able to explain it or show it to a young person. Look up the equation for roulette. What is the probability that you can make money with roulette? And roulette has an expected value of you will get 95 cents back on every dollar that you bet. What? Yeah, that's because when you look at the way a roulette table is built, it has an O and a double O that you can't win on. So you lose 2 slots of, you get to bet on 36, but there's 38 slots where that ball can land. And so that's the edge that the casino takes away. So the expected value of roulette is that for every dollar you bet, you'll get 95 cents back on average. And that's a beautiful thing too. That taught me about trading success. With trading, you have to look at how often you win and then what the size of your wins are versus how often you lose and what the average size of your losses are. And you put it together just like the expected value equation for roulette. Now, so for traders, what traders would have to do to succeed with that is you would keep track of your trades. So let's say you have a particular trading method. Let's say you buy 20-day new high breakouts, or you sell ascending wedges or something like that, or whatever you do. But you do something consistently to keep track of your trades, and then from that data of keeping track of your trades, let's say 100 trades or 500 trades, now you have year past data to track. And then what you can do is say, okay, what's my percentage of winning in, let's say, 100 trades? Let's say you win 60% of the time, which is great. And your average win size is, let's say $150. Well, then now what you do is so you multiply that, because then you get like this average win component. So let's do that real quick. Let's just I'll give you an expected value here for how we do a trading system. If somebody kept track of their results. So what did I say? So 60% of the time we're going to make $150. So that's $90. And then let's say the 40% of the time that we lose $200. Ooh, that doesn't sound good, does it? Let's not make it that bad. Let's say 40% of the time you lose $175. Okay? So that's $70. So if you can make on average $90 and then on average only lose $70, you have positive expected value. In that case, it was $20. Let's say though your losers were $200, so significantly higher than your average win of $150. So 40% times $200 equals 80. So now you're getting into a territory of having trouble making money, since your average loss is so much higher. So you can balance this out. You can have an average loss that's high, but really you need to be an excellent trader and win a lot. So it's better to have a reasonable expectation of your trades winning and a high dollar amount win. Your average win be that much higher than your average loss. And this really makes a difference over time, obviously, because where traders run into trouble, and this is where the psychology part comes in, is they do the wrong things. They fight their system, even if they were supposed to have a 3-to-1 risk reward ratio, meaning I'm risking $1 to make 3. So I'll cut my loss when I lose $1, and I'll take my profits when I make 3, or let's say 2. If you don't follow that and you don't collect those big wins of $2 or $3 versus every dollar you lose, then you end up with negative expected value. Okay, so that's trading and roulette and expected value. If you want to see more of these examples, I did a video series over 10 years ago when I was at the options trading house, Peak 6. I came in there to help them create options education for retail traders via their brokerage. And I did a video series called Options Physics, where just teaching basic options mechanics and stuff about volatility. And I have a video called How Not to Be a Sucker. If you just go to YouTube and put in How Not to Be a Sucker, maybe you got to throw my name in there, but even if you put in How Not to Be a Sucker, I think I'm like the 5th or 6th result. And it's a 4-minute video where I use another dice game to explain expected value and probability. So go check that out. All right. Now let's do 2 more probability lessons real quick. Powerball. Teach this to your kids, because then they'll understand how ridiculous it is for anyone to play Powerball and believe that they're going to win. Now, you could throw a couple bucks at the Powerball and, just for fun. But if anybody has a parent or friend who gets up in the morning and can't wait to check their Powerball tickets to see how great their day could be, they need some simple math education. And the one example I love is to show you how hard it is to win the Powerball is, and you probably already know that the Powerball odds are about 292 million to 1. Who knows? They probably changed it by now, and it's like 300 million to 1. I think the Mega Bucks even went over 300 million to 1, but roughly 300 million to 1. So here's how big that is and how hard that is to win. From Boston to Los Angeles is 3,000 miles. If you lined up baseballs from Boston to Los Angeles of that 3,000 miles, I think it would turn into something like 63 million baseballs if they were all stacked next to each other. And I just figured that out because if you say baseball is like 3 inches, then you take 3,000 miles, turn that into feet, and you end up with 63 million baseballs. So if you got in a car in Boston and we're going to drive to LA, and one of those balls, one of those 63 million baseballs was the winning Powerball, and you could win, let's say, $500 million. Now all you got to do is figure out where you're going to stop, where that baseball is. 3,000 miles. So, what state are you going to stop in? You only get one shot at this for your $2. If you want to spend $10, go ahead. We'll let you spend $10 on the Powerball, and now you get to stop 5 times. So where are you going to stop? You're going to stop in Ohio. You're going to stop in Colorado. You're going to stop in the desert somewhere, and then what county, what town, what street? You see, 63 million baseballs to choose from. Well, the Powerball is almost 4 times harder than that. If you think about, so 63 million, times 4, it's almost 5 times harder than that. If we're getting up into the Mega Bucks, that's over 300 million to 1 odds. That's how hard it is. So really, to win the Powerball and to relate it to our baseballs lined up across America, you'd have to make the drive back and forth, 4 or 5 times, just to pick your winning baseball. So that's a fun one I love to tell kids about how hard the Powerball is, so that they can teach their parents not to play it or not to hope for winning the Powerball. Now, how about a lottery game that might be easier to win? In Illinois, they have one called Lucky Day, and you can win 100,000 or a few 100,000 with odds of only 1.2 million to 1. Now that's a whole lot better. 1.2 million to 1 could win you anywhere from 100 grand to, so I think sometimes occasionally it gets up to almost $1 million. Only 1 in 1.2 million. So that seems much more reasonable than the Powerball. Now I've seen people play this, and one day I was in the store and somebody, by the way, there's only 5 balls. It's not like the Powerball where you have to pick 5 and then you have to match the Powerball too. This is like just 5 numbers, say, and it's in a combination of, let's say, 45 numbers. And that's another fun thing when you actually teach kids how to calculate the math for one of these games. Then you get to teach them combinations versus permutations. And that's some fun stuff. But for this game, you only have to hit 5 numbers. And obviously, order doesn't matter and the numbers don't repeat. And that's why, like, if you made it that the order mattered in any of these games, the odds would be so much more astronomical. But the lottery people, they're really nice. They let you have better odds because the numbers don't repeat, and order doesn't matter is the main thing. So if you hit only 4 numbers in this lucky game, 5 to win the big pot, but if you only hit 4 numbers, you win $200. 200 smackers if you hit 4 of them. That's pretty good, huh? One day I'm in the store and somebody hit that. They hit the 4 numbers. They're checking their ticket. And the person standing next to her said, "Wow, you were so close to the big money." Now, if you think about that, the odds are orders of magnitude different between because I guess the odds, if we calculate it out, it'd be something like 1 in 5,000 or 1 in 6,000 of you hitting all 4 numbers. That's the odds of hitting all four numbers matching out of 5, and you get $200. But remember, we just talked about the odds of hitting all 5 numbers are 1 in 1.2 million, because that's how many combinations there are, not including the ordering of the numbers. So, yeah, the numbers 4 and 5 are close together, but the numbers 6,000 and 1.2 million are not close together. And that's the failure that people have with probability. It's like saying, "Oh, you hit your lucky winning number of 14, or let's say your lucky number is 14, but but it came up 13. Oh, you were so close," just because 13 and 14 are close to each other. So that's another common failure of people who play Powerball games and so forth. So I made up a game. This is the last lesson here. I made up a game, a way for kids to think about the probability of winning any game where the odds are 1 million to 1, where you're spending your hard-earned dollars to win something like, let's say, $100,000. Let's say you could win $100,000, but the odds are 1 million to 1. So just how hard is that? So what I did is I thought, well, what if you were standing over a big stadium or a giant Olympic swimming pool or a basketball court? Basketball court might work, yeah. And there were 1 million little boxes below you that you could throw a quarter in. And if you think about it, that works out. So a quarter is almost an inch in diameter. So you're holding a quarter. The question is, how far can you throw a quarter? And before you are 1 million boxes, and you just have to hit the right one. And so that would be about the size of a basketball court, because you need, we're doing a 1,000 by 1,000 is 1 million. So 1,000 inches, that's like 83 feet. 1,000 inches is 83 feet. Yeah. So 1,000 by 1,000, 83 feet by 83 feet. So I'm turning a basketball court into more of a square, but picture about that size. And all you have to do, let's say you're up in the 10th row or something, is throw a quarter and hit the right 1-inch square box, and then you win. Now, I think any kid could relate to that. Oh, yeah, I can throw a quarter, and I just have to hit the right winning box, and I win the money. I think after they thought about it for a while, they'd realize exactly how hard that is. There's a million little squares out there that are 1 inch wide, and I have to, because man, even if you knew the vicinity of the winning box, if you throw the quarter and you could bounce right off of it and not go in it. But in reality, we don't even know the vicinity of where the winning box is. So I made that up as a fun game for kids. And if we wanted to relate it to how far could you actually throw a quarter, because I got to go out and try this like on a football field or something. I asked a couple guys in the office, how far do you think you could throw a quarter? And of course they started talking about, well, there's wind and how you throw it. And I'm like, well, and would it bounce? I'm like, well, no, just because we also have to do a little bit of math here, because 83 feet, what's that? That's like 30 yards, right? 83. That's 27.66 yards. So let's say you're standing in the end zone on the goal line, and you want to see if you can throw a quarter to the 40-yard line. Well, if you can throw it to the 30-yard line, then you've got the distance of one side of our big box, which is 83 feet by 83 feet. But if you wanted to throw it all the way to the other corner, then you'd have to know the hypotenuse, and there we'd have to use Pythagorean's theorem, right? So, what would that be? So 83 squared is 689 times 2, and then divided by, we have to find the square root of that, sorry. That comes out to like 40 yards. So to hit the far corner, you'd have to throw the quarter 40 yards, if that's where you thought the winning box was. Anyway, fun game I just made up to get kids to visualize math and get them interested, right? Not everybody can stare at a math book and look at equations and have it mean anything to them or intrigue their curiosity. So math isn't just about equations. Really, it's not. It's it's in life everywhere. In when I learned about options trading, since I never had done any kind of differential equations, I had to learn about curvature. Well, curvature is this cool thing that actually represents, how nature is. Nature is not full of straight lines. Nature is full of all kinds of curves. And that's where math becomes really fascinating. All right. I think we'll pick this up again next week, because it's just something I can't stop talking about. This could be my longest podcast ever. All right. Thanks for joining me on Mind Over Money.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.